I'm at a point where it's giving me enough returns that I can my own salary. And you're getting financial data and creating mathematical models to make either predictions or analysis that can give you signals. There's no capital markets without economics. It's funny because when you're an academic in finance, you learn that the market is very efficient, but I would say it's mostly not efficient. Don't kill me for saying that. But, one of the biggest weaknesses of the market is FOMO, right? 2024, it's almost 50-50 now. It's mostly like there's a lot of retails, and that's supposed to surpass actually institutional traders. You know, the more the stock went up, the more collateral they had to give it to the bank to keep that short position open. So they lost billions and billions of dollars. With ingenuity, you know, engineering of everything, you're creating something new.
Big titles, big roles, but what do they actually mean? I'm Ines Hiraki, and this is From Wall Street to Main Street, breaking down business jobs, one conversation at a time. Hello everyone, welcome back to a new episode of From Wall Street to Main Street. Today we have the chance of being with Joao Zimermann, who is a quantitative investor. Hello Joao, how are you?
Hello, I'm good. How are you?
I'm good. Thank you for being here and taking the time
Thank you for having me. Yeah, I really appreciate it.
Yeah, it's nice having you as well. And before diving about quantitative investing, I want you to explain us what you do. If you had to explain it to someone who's not in finance at all, with no financial terms, what do you do?
Yeah, perfect. Well, this is a difficult question. So what I do, basically, I use financial data to create models using, let's say, coding languages or Excel. And you take that data, you compile it in a nice organized way, and that data can help you invest, I guess, in an easier way because you get to work with multiple tickers, I guess, of stocks. That way you're not constrained to just what you know and how many, like if it's done manually, you can only see a few tickers. So quantitative finance allows you to organize the data in a really good manner and use that for investing. And that opens the door for many capabilities in terms of data, signals, and everything you have in terms of the market.
Okay, so basically it's creating a tool to simplify all the information in the market to make investment the easiest task ever, I would say.
Yes, exactly. Yeah. So it would be like taking thousands of data, millions of data, and putting in a system that can compile all together. So it gives you signals for everything you need, basically. Yeah.
Okay, and so in your own experience while you were starting investing, was there a pain point where you noticed that, okay, actually, I think I can build a better model than what's available so I can do better investment?
Yeah, so when I started investing, it was pretty much very beginner. I was investing myself. I was watching the news, keeping up with trends. I would look at financial data for companies I like or that I thought could be investing. And then the more I got better at that, the more I started looking at more data. I was writing down all these companies, what they do, how are their earnings. And at one point, I started getting really into it and started getting better. And then I saw my limitations, right? Like I can't possibly read all the data in for so many companies in time constraints. So I need to organize them better. So as the time went by and I kept investing in different names and kept increasing my portfolio, what happened then? It created this necessity of, okay, I need to organize everything, and that needs to be good in such a way that I can easily see what I need to see and then make a decision on investment, basically. Yeah.
Okay, that's great. And so before doing all that, investing on your own and analyzing a little bit about the financial models and everything, let's go back maybe to when you started university, started studying. So you studied at University of Toronto, then IB, you worked at NASDAQ. Can you tell me a little bit about your background, everything?
Yeah, for sure. So I started my financial career by studying finance and economics at U of T. My goal, actually, I started with economics.
Okay.
And then when we got to the top of financial economics, that's where my passion triggered there. I was like, you know what? Finance seems really nice. And that's when I decided to take on the program as well. And then I started really liking both finance and economics. And, I guess at that point I wasn't sure if I was going to work with investment or even finance for that matter. I really liked economics and I thought I'll probably work with some economic policy or something like that. And as time went by, I started reading like finance. During that time period, I had a small business that I was running in the school. So it became the startup.
Yeah, I feel like when you understand a lot economics and how macroeconomics works, the interest rate and everything, when you transition to finance, it helps a lot to understanding how the big banks make their decision and how the economic environment impacts the financial market. So having this type of knowledge, I think it makes the transition easier and it makes you understand the context of financial market as well.
Yeah, you're totally right. Like there's no capital markets without economics. Economics is like I would say, fundamental. You can run from the economics of it being macro, micro, or even, statistics in economics. You can really run from it. I know people don't like it. Sometimes people like more than finance than the economics, but you need to know economics. For capital markets, I would say the biggest things are economics and account. Okay, you need to know. I personally hate accounting, but
you
it's
need
one
to
of those
be
things
able,
that you need to know.
you need to be able to read the statements and everything to understand what information, how it comes there, how it got there, and everything behind all of those numbers. So having this type of knowledge, you cannot neglect that to be able to understand markets. So yeah. And so you had your business on the side. You worked on your business on the side while studying at university?
Yes, I had the opportunity to open. It started actually as a project for my economics class. And me and one of my friends kept refining the idea. I wrote a paper on it. And then my professor thought it was good. And then I was like, oh my God, should I put this idea into reality?
What was the idea?
Yeah, it was a marketplace, an online marketplace, kind of like Amazon or Kijiji. I thought that, eBay had an in between where it's listings and I guess the marketplace like Amazon. But I thought there was nothing like eBay or Amazon or Kijiji peer to peer with payments, right? So I think Amazon and eBay, rightfully so, they focus on commercial clients, like big commercial clients or B2B. Whereas like I wanted to focus on like B2B, B2C, and C2C, right? Customer to customer. You're able to sell something online and another customer can find you. And the idea was to create this matching algorithm. That's when I started working with algorithms for that. And then, I pursued this idea. I was fortunate enough to be able to sell this as a business after university was done. And then that's what led me to pursue full-time finance. I knew I wanted that. And I started at CIBC. Then after CIBC, I did my master's and then I worked on the NASDAQ. Now I have left NASDAQ and fully working full time with my own quantitative model.
Okay, there is a few points I want to go back into your career. So when you first started your project in the economics class, it required a little bit of algorithm coding.
Yes.
So how did you get that first training about building algorithm? Did you learn that on your own? Did your professor help you? Did you look up online? What was the process for you to learn how to code?
Yeah, for sure. So at that time, no ChatGPT, unfortunately. But at that time, what happened is I had to do this paper. I mainly did using algebra and functions, so just on paper, so you get an idea. Obviously, that when you do that on paper, it's good, but it's just too static. You don't know how it changes with different factors. You can do it, but it's just really difficult. So I knew I had to use some sort of system. At that time, I did the research using this data, which is this statistical software that the school basically makes us learn. It's very robust, especially for economic data.
Stata?
It's data, yeah. And I use that basically for the model to make like charts and really produce the data I wanted. And then I actually didn't have technical skills at that time to create the entire system because I at that time I didn't know any coding. And so I decided to get assistance, so with third party providers. So I that's when my team started forming actually when I hired a developer, front end and back end developers, and I also started hiring marketing teams and everything to see how the idea can come about. Yeah.
Okay.
Yeah.
And so later on, you said you graduated, then you did your master at Ivy.
Correct.
No, before that, you worked at CIBC, right?
CIBC, yeah.
And so what industry of finance was that, and what made you go there, and then what made you decide to go do your master?
Yeah. So after I was done with the business, I decided to sell. It grew too much for me to be able to manage with a small team, and the costs kept increasing. For you to get even bigger, in a marketplace style, you need a lot of investment. So I reached that constraint point, and then I felt it was just better to sell it and then transition to something different. And that's when I decided to go finance. And then I applied to CIBC as an investment analyst under the securities lending desk.
Okay.
So securities lending is basically how banks and other financial institutions, they basically lend securities, so bonds, stocks, to each other to cover some sort of loan and borrowing they need to do. So if, let's say, CIBC wants to borrow, say, $100 million from TD, they have to provide some sort of collateral. And then that collateral will usually be some securities, and then they can exchange after.
Okay.
And so that's what I worked with. And my whole job was to really find out which securities we wanted from another bank that was trying to borrow from us.
Okay.
And then which securities we want to give if it's vice versa, because you're always either borrowing or lending. So, so that was my first experience with capital markets. I think was very good because I was in the boring side of capital markets. And I think that's honestly the best advice I can give to someone that's starting. The the boring side of capital markets, which is usually your corporate actions or, lending and borrowing, I would say bond that things that are more operational.
Yeah.
They're very boring. They're a lot of work. I know everyone hates it, but I think that part of the market really gives the foundation for people to know what's happening actually in the market behind the curtains. Who's actually moving the money? Who's actually confirming the money out there? And what's the time constraints? And what's the actual, like, who's actually doing that? Because I think when we enter finance, everything's so abstract. You're just seeing these numbers moving up and down, people buying and selling. But what does it actually means and what goes behind the curtains? You only learn with the boring job.
Okay.
Yeah.
Yeah, no, you're right.
Yeah.
And so later on, you decided to pursue your master at IB in financial engineering?
Yes, exactly. So during my time at CIBC, I got more into data, and I thought I had this gap in knowledge that I did wanted to, work on. And so I decided to apply for a master's in basically data analysis and data science, more for business. And I saw the program at Ivy offer that. So then I applied and I went to do my master's there.
Okay. And after that, you started working at NASDAQ and you did some equity research. Can you tell us a little bit more about your path at NASDAQ and how was that different from the models you were building at home?
Yeah, for sure. So during my time at Ivy, that's actually when I started getting really into investing and more quantitative investing. So I was doing some, systems and working and seeing how could I perform. That's when all started, I guess, in a more complex manner. And during my time at Ivy, besides doing those models at home, I got an internship at NASDAQ under the surveillance team, which involves a lot of equity research. I would say it's not equity research as someone might think in the street, like, because equity research has different departments. And because I worked at NASDAQ and NASDAQ is an exchange, we're basically an in-between buy side and sell side, right? An equity researcher usually works on sell side. They usually post, sell side notes and research. For us, like I would say for the market, like, for someone that works in the market, so like either the NYSE or NASDAQ, our jobs actually we're in the middle. We're analyzing data from buy side and sell side. And our goal is to advise the client, which is a listed company. So basically listed firms, any public firm could pay NASDAQ and then get a service from surveillance analysts where we're trying to find out, do a market intelligence And our goal is to find out who's buying or selling stock and why. And then we tell that to the client on a daily, weekly, and monthly basis. And we also do reports on it, and we try to build predictive models. And then that way the client knows who's moving money, sorry, their stock, who's either buying or selling in terms of the institutions.
Mhm.
That was basically the job.
Okay. And so you recently left NASDAQ to pursue your own quantitative models.
Yes.
What motivated that decision, first of all, and also how that allows you to explore and pursue something that you couldn't before?
Yes, for sure. I think my decision to leave NASDAQ was basically I've been working with this model since IV, as I mentioned. Then I've been working NASDAQ for two years and a little bit. And during this whole time since university to NASDAQ, I've been building my own systems at home for modeling, financial modeling, quantitative research, and putting all together. And as the time went by, it kept getting better and better in terms of, I would say, returns. And I felt that I was coming to a point where it was really hard to spend time in the system in a meaningful way where I can get better results as was getting more complex and having a job at the same time.
Okay.
And I think when that became a reality, I was like, you know what? I need to focus on this full time. I'm at a point where it's giving me enough returns that it can be my own salary at this
Wow.
point. And then I decided to really work with the models.
Okay.
And that's when I decided to leave NASDAQ and put full time attention into the system.
Yeah. Do you think it's very, I'll not say very common, but to be able to live off the salary of a model model you built, created? I don't feel like that's common. Do you know anyone that has
No,
the same situation?
yeah, it's not. I would say it's not very common in terms of entering the quantitative trading or investment. I think there is a barrier to entry. I think that's why it's not very common to see people, I guess, trying on their own.
Mm-hmm.
One, there's technical challenges in terms of what you need to learn. You need to learn coding, quantitative finance, financial mathematics, and a bunch of different, I guess, things in terms of geopolitics, geography, economics, yeah, accounting.
Yeah.
So you need to get a pretty good grasp on all of this and put it all together. So I think that's the first barrier. Besides obviously the cash you have, to put it towards investing, not just on the investments itself, but you also gonna need the technology, right?
Yeah.
You're gonna have to pay for maybe a server, a database system, and you can definitely start on your own at home, really small. That's what I did. But I think with all these barriers together, it probably deters a lot of people that do want to enter this market to enter, which I'll say it's a fair argument if you think that's too much. But I would say you don't need to start with everything, right? You don't even need to start with a full running model. You can just keep going on your own. I think with investments or trading, it's the more you can learn, even if it's just a little bit, the better your investment decisions will be, even just a little bit.
Yeah.
And the more you keep adding to it, the better it keeps getting. So there's no, I think, rush. So I would tell people don't get discouraged by all the barriers to entry.
Mhm.
But they are good to keep them in mind to see if that's what you want to achieve, because the more, I guess, it's definitely a field that takes time, patience, and a lot of patience, to be honest, because it can be repetitive, and it definitely requires you to learn all the time. Every day you need to learn and put more things into the system and find out, oh, how can I use this and that, and be very creative.
Yeah.
Yeah.
Actually, what you brought up brought multiple questions on my side. First of all, you said that the first barrier would be like all this technical knowledge, like financial mathematics and everything that you explained. Do you feel that all the knowledge that you acquired to be able to build that model was something that you learned through your bachelor and through your master, or did you have to do a lot of work on your own to learn even more tools and be more an expert in those tools?
Oh, that's a good question. I think a lot of the knowledge, because it's specific to investments and I would say like uh, or trading or quantitative research, those require very specific knowledge that I would say maybe schools, your academics might have touched on it, but it hasn't. It isn't very complete for that. So I would say there's a like there will be a almost 90% self learning, like
Wow.
where
Yeah.
you gotta learn different skills, be able to apply those skills to this specific thing. I think school is great in terms of the base knowledge you can have. I think your 4 years of undergrad, even your master's, they give you foundation. They teach you about different models, how like things that happen in history with finance or with economics. And then it teaches you kind of like how to do simulations or whatever it is, right? Whatever you're learning in school. And I think that's important because when you have to learn something new, you don't start from zero. You have this huge step,
Yeah.
and then you can start really focusing on applying that knowledge, refining it, and then obviously transforming to what you need.
Yeah.
Yeah.
There was two other point in what you said that brought my attention was the fact that you invest on your own. So it's your models gives you your own investment. And one of the key thing that impacts people's investment is emotion. We say that for someone to get very like in our fifth episode with the director at JP Morgan Asset Management, he told us the three rules to be able to get very wealthy very fast. It was have a good revenue, of course, spend less than what you earn, and invest without emotion. So like usually most of the people they give their investment to someone else, to asset manager or someone that manage their fund, so they don't get impacted emotionally. So as someone managing your own investment, how do you dispatch that emotion part from your investment?
Yeah, I think that's it's a really good question, and I agree with the JP director too. I think that's what led me to quantitative finance is the idea that I knew that emotion is probably the biggest weakness in the market for different reasons. And I knew at the very moment that I decided that I want to do this, I'm interested in this, I knew I had to take that variable out. And that's why like I knew how important it is to do quantitative finance. Even if you're not going to do a lot of trades or even for investment decisions, quantitative finance allows you to take that whole, I guess, branding and motion or what you think a brand is and what they do out of your head. Like you don't get these biases, right? And you can really focus on what's the data telling us, right? And that's why I think quantitative finance allows you to check things as they should be. Like as you know, especially when you're investing or trading, you really need to see the health of a company and everything. And if you get caught on branding or emotion or attachment to a certain brand or, or company, that can definitely influence your judgment. And that's why I think it's really important to focus on the data. And I agree, emotion is probably the biggest weakness for any investor in any market, professional, retail. It affects all of us for sure.
Yeah. And one of the third point that you mentioned and that triggered my attention, and I think I didn't notice that before, is that you said that you're able to live of that investment as a monthly salary. So as a monthly salary, when we think of investing, usually we talk long term, and which means not having to withdraw money from the investment. So is there a specific strategy that you use to be able to make monthly withdrawals from the models?
Well, I don't. So I think that this is good to distinguish things. So you're completely right. In an investment scenario, you wouldn't take money from it. So an investment is always long term, by its own definition, because it's money you're not going to use. You're putting aside to grow. When I was making these models, I started to make it for investing, and I still do. So there's a whole side of it, which is like portfolio management, long term investment. The other side of it is that I started actually more recently, especially when I left work, is the making revenue. So, and that's very different because now I have to create a system where I'm not investing, which is what I was comfortable with, right? So I still do that. So that's long term. It's not something you look at it, let's say every day.
Yeah.
Whereas the trading, which is like generating revenue as a business, so I can get like, let's say a salary or, get, invest in that business. So that's very different. So that the focus of that is to make revenue. And so it doesn't follow any of investment strategies you would think of.
Yeah,
So
because
it's very like, like, oh, I want to make revenue off those strategies and not really treat them as investments.
Yeah, because the thing is that if you follow a usual strategy, then the day the market is down, then that month you won't get a salary, and that will be pretty bad. But I saw there is some ETF that actually are built for revenues and for people that want monthly revenues, and they use kind of a leverage for that. Does it works the same way?
No. So those type of ETFs for covered calls, what they do is that they basically they use call options to leverage that stock, as you mentioned, and they for the contracts before the contracts expire and these very short term expirations, um, they are able to close that contract in a manner that you can get a huge let's say dividend from that ETF, which is the yield. Uh, those are what we call like almost like a fixed income strategy using ETFs. They are not, and I really want to be careful here. They are on its own. They're not a good investment device. They are very, they do that job well, right? They give you a high dividend yield, but you definitely have costs to that. One, you sacrifice any upside from when those calls were closed, right? So if you imagine, let's say you invest on an ETF that tracks Apple stock and you invest on the corporate call ETF so you can make dividends. That's great. You're going to make the dividend, but you're going to limit your upside, right? If Apple goes 100% up in that period of time,
you won't benefit from it.
You completely miss that. In fact, it's really bad because not only you miss that, depending on the times those call contracts were created, you can actually lose your total asset value.
Okay.
So
it's a complementary. It's like hedging your investment.
Yeah, they can be good for situations where you want to put a little bit of weight on that, so you create some dividend in your portfolio, so you can have cash to invest on other things. On its own, I wouldn't say it's a good investment avenue. I think you can use to mix it up, and if you're definitely more technical with things, you can create strategies on top of that that can be beneficial.
Okay, so we went through a little bit of your career. I know we went a little bit like over some point in details when we're gonna go more in detail actually right now, and we're gonna start about the basic from the basic from the basic. I know we went into calls option and things like this, which is very detailed. But let's go back to the base, and maybe if you can explain us what's a financial model. Very like that's the most basic thing. I think we should have started with that, but still it's just very basic. What's a financial model?
Yeah, for sure. So a financial model is just a mathematical model, basically. Usually mathematical. I would say it's always mathematical because of coding involved, but it's where you're getting financial data and creating mathematical models to make either predictions or analysis uh, that is that can give you signals. So, for example, one can create a financial model around gold. Let's say you want to invest in gold, and you can basically find out what are the main factors that can affect gold pricing or gold demand and supply, and then put that all in that mathematical function that can then try to predict if whether or not demand is going to increase, decrease, or price is going to change or not. So that's basically the financial modeling is just creating a mathematical function that can give you signals for whatever purpose you need in finance.
Okay.
Yeah. in a nutshell.
Okay, that's great. That's a good start for everything we're going to go through in detail. And so, as someone building those financial models, can you tell us maybe what a typical day looks like? Is it more research, coding, monitoring? What does it look like?
I think it's all
All
of
of
the
them?
above. Yeah. I think obviously in a big company, you have different sectors, right? You have someone that does the quantitative research, someone that is the quantitative modeling.
But you do all of them.
I have to do all of them. One guy shows, so I have to do all those specific things plus the actual actionable things of the trading or investing. So the the idea is that I think the most important part of the modeling is the data, right? You need to find a data provider. Those usually comes at a cost. For someone that is starting, you can definitely get a financial provider that offers less data and not up to date. I know that sounds terrible, but there are some financial data providers that for free they'll provide financial data. uh they won't be up to date like currently, but they are maybe a week old data and historical data. That's a good start. It's a perfect start, and I think that's how I started. I went with a free data provider and I started with that, and as I got better I started improving the sets of data. But yeah, the most important part is definitely data. You want good data, you want them to be reliable, and then you need to focus on organizing this data, structuring, and then cleaning up all that.
Yeah.
Yeah.
You were actually talking about a few steps for the portfolio workflow, organizing, screening, all of that. I want to go through a little bit of these steps. So there is the usual steps that are, and let me read it so I cannot be false: ingest, screen, rank, optimize, rebalance, and monitor. Can you maybe guide us through and explain us what's the goal of each of these steps without going maybe too much in details or too much technicality? What's the goal of each step in building the model?
Yeah, I think I guess those processes are very specific to my system, I would say. So I'll try to tell it in a more general way of this process, what is needed. So for someone that's trying to start with financial, I would say even financial modeling in general, is that one, you want to know, basically, you want to get the data. The whole part of ingesting that you mentioned in the beginning is that basically you're getting the data from a provider and injecting it in your system. So that can be a database, an Excel spreadsheet, or anywhere where you can save that data and manipulate it. That's very important. And then once you have that data, there's few steps of data management, which is the cleaning, organizing, and structuring for what you need. So maybe like you have a number that is in billions, and then you needed to, I don't know, change the decimals to work with your equations, or maybe you need a data set to change its name, or to maybe you need a ratio between two different data points you got. So all that.
You adjust it to match what the bulk
Exactly. Yeah. So that would be, data gathering or mining. That's what it's called. Then you have the data cleaning. And then you have organization. And then you have data transformation. And that's where you're going to create what your model needs. So the ratios, or maybe, you want to create a whole function with this data. And that's, I guess, the last part. And that last part can only occur if all those steps have been done perfectly.
Yeah.
And I think that's really important, because if that part of the data entry is wrong, your entire system will be wrong.
Yeah.
So that's why it's really important to focus on that first, creating that pipeline that gets all that done first, and then you can start the model, the actual, I guess, actions into it and your research and everything. That's the most important part.
For that step, particularly, let's say you have like weekly data that comes in from your provider. I guess the steps that you do to clean up the data, transform the data, and all of that are kind of repetitive steps if it comes in the same way every week. So is there a way to automate
Yeah, to automate it.
Automate it, sorry,
Yes.
and make it like
Yeah.
faster. And is there a way to check if there is no mistakes to make sure that then the final that
Yeah, that's the most important step in this whole I guess first part. One is that so and that will depend on the data provider. So each data provider will provide the data in some sort of way, either Excel spreadsheet or JSON format or whatever it is. Usually a robust data provider will have all the ways, like you can request that in Excel, a CSV file, or XML file. You can ask in all those type of things. Once you got the one you need, you create a system that can digest that data and organize it. Once you do that once for each file type, you don't need to repeat that again. You can use the same thing for all the other data points you need, right? So that gets completely automated, and you do want that automated. And I guess the next point you ask, I think that's very overlooked, especially for people that start at home or even, to be honest, professionals, which is the data verification. Did anything go wrong? So we call that quality assurance in computer science. And that's probably going to be the most in demand field for computer science and software engineers moving forward, in my opinion, with AI. Because of this very point. AI or financial models, anything that is automated, run the risk of having a little bug here or a faulty system, or maybe it didn't get a connection properly. So quality assurance softwares or actions that it can do uh, helps you in finding out if there was any errors happening in any of those steps in the pipeline. Okay. And you have huge companies that are quality assurance providers, but you can definitely start on your own at home, creating a little warnings here and there where you can keep an eye on things. Yes.
Okay. And so when you build all that portfolio with all those steps, it gives you an outcome about the best stock or the worst stock or things like this.
Yeah, you can. You can. The idea, I think the primary idea is to create signals. It's where, and by signals, I mean, so after all that, then you run the code and your system, it can tells you, for example, can give you a signal how that stock perform in the short run or how that stock can perform in the long run. It can also give you signals of how is their financial health of that company in terms of are they do they have enough liquidity, like in terms of the stock, or in terms of the company, do they have too much debt, or do they have are they the free cash flows after everything, are they good for the shareholders? So you can get signals for all that. Now those signals you can put together in any way you want uh, to then create maybe a ranking system, like you mentioned, where you can choose the best stocks. But all that will depend, right? You can have a ranking system maybe for an investment portfolio, or maybe just for a ranking system for on a day trading basis to generate revenue. So it really depends. It has to be malleable for your needs.
Okay.
Basically. Yeah.
Okay, that brought up actually two other questions. The first one would be, like you were just saying about the ratios, the debts and the cash flow of a company, all those are kind of quantitative data that you know about a company. How are you able to input more qualitative data? For example, there is a new decision that has been taken in that company, or the governance change, or like there is a new strategy that's going to be implemented. Those type of data are not usually shown on the income statement or on those type of financial information data. So how are you able to implement this type of non-quantitative information into the models?
Yeah, I think that's a very good question. I think that's what kind of like separates your model. I would say a generalist model to from someone else or other companies is the non-qualitative part. That's actually very important part. I would say is the extra 50%. And that is also the hardest part, because when you're trying to look at data that is non-numerical, for example, maybe it was a CEO presentation maybe it was investor relations meeting or earnings call. All that are those things are made of text, right? They're non-numerical usually in nature, and but they do provide a lot of information.
Yeah.
And they're fundamental for any robust, I guess, trading system, especially for more advanced strategies. And the way you would work with this is that you can do manually, really listen to those calls.
Mhm.
And I actually would advise anyone that is started on this to really start anything manually. So you really know how you would have to put that in terms of like computing, but you need to know you'd actually create you talk to a data provider that can provide that text, and with those tags, it gets a bit complicated, but you'd create algorithms that can read the text and then create what we call a sentiment analysis on whether it's good, bad, neutral. And with all that, then you can create numbers from that.
Yeah.
So let's say, uh,
You make your own scale.
yeah,
Like,
exactly.
is it
Let's say
good?
you're
Is it
creating
bad?
a 0 to 10 scale. You can put good is anywhere from 7 to 10.
Mhm.
Maybe 10, you can call it great.
Mhm.
And then from, below 7, it's from maybe 5 to 7, it's neutral. That really depends on how
Yeah.
you want
That's so interesting,
to
actually.
put.
Yeah.
And so that sentiment analysis will become then a numerical
Value.
representation of those wordings that then you're going to use it,
Mhm.
right? So then basically, then you can input that in the model. Hey, if the earnings call had a sentiment analysis that shows an output of great, let's like, bump it up in your ranking or on your system, right?
Yeah.
So that's really important. Yeah. So as I was mentioning, so what AI enabled people was to create very robust automations that are easier in a way to do to grab those non-numerical data like earnings calls and things like that into numerical data to use in their models, basically. Yeah.
Yeah, especially the fact that AI allowed us to translate human words into coding language and otherwise, I think that's a step that makes it easier for everyone, not only investor but also all of the people.
Yes,
Yeah.
I agree. Yeah, the capability of being able to read and understand a
Mhm.
file, I think uh
Yeah.
that's what AI is good for. And most of the times when we talk about AI into finance and quantitative finance, is this I would say 80% of it is non-numerical data
Mhm.
and understanding and really contextualizing that
Yeah.
non-numerical data into a numerical data. Yes.
Yeah. And so let's say like your portfolio, you said that it gives you kind of a ranking of the best and the worst stocks. How, let's say that's the goal of your models. You said there is multiple goals
Yeah,
and you
there's
adapt
multiple
that.
goals.
Yeah.
Yes.
You adapt that to what you want. So let's say it gives you like kind of a ranking of the current stocks. How are you able to translate that ranking and that best or worst stock into actual portfolio decision? And let's say for example, you find a stock that is really bad, I would
Yeah.
say, and you think it's overvalued. What strategy are you going to use to make money out of that?
Okay, yeah. So that's the whole thing. So your main quant model, and again, that's very specific to my system. A quant model could be for anything like real estate, stocks, or anything. And even within the stocks, it can be just for specific sector, industry. So it's very malleable and very specific to each system. I work with equities mainly, so stocks. And the way my system does is that it tries to find, based on my models and what I'm predicting, it scores and ranks stocks based on different metrics. So short term metrics, medium term and long term. And all those metrics, all those models, what it enables you to do is give you a base framework. I call that the investable universe of stocks. Uh, that's like my base. So those are stocks. Hey, the ones that are ranked high, I can say, hey, you know what? Those are good stocks that show either short term or long term or medium term health. I think it could be something there. And then obviously you can take the bottom of the ranking, right? upload those models you made and be like, hey, those are the stock's probably going to do really badly, or right now in the short term, medium term, or long term. The idea is then you can fit that investable universe of stocks now to specific models. So you can have a portfolio management model, and I have a portfolio management model that I use for myself, but I also license this model for other investment companies and investors at a price. And then I have my quantitative model that can be used for maybe a short term trade uh, decision or a swing trade, like anything like that. And the difference is, so once you get the base, you can apply to specific models. When it comes to portfolio management, that's a whole like portfolio management requires a lot of modeling in itself, and you have pretty standardized models that work with portfolio management, taking into account a client's risk appetite, time horizon of their investment, how much, what's their goal? Is their goal to buy a house? Is their goal to, just keep generating wealth? Is their goal to save for their children? Each one of these variables is gonna make the model change for that. Well, it should at least to change for that customer, right? And that's the challenge. The challenge is once you have the investable universe of stocks that you used your quant model, right, which is a very robust model, you have a pretty good base where to start. Then you can use other models to fit that data into a specific client, right? Okay. So if you came to me and you're like, hey, okay, you know what? I want to create an investment account for a house because in 4 years, I'm buying a house, and I think by that time, I want a house to get more organized, whatever. Mm-hmm. So then our goal is really like forcing this other model, right? To really look at your profile, especially your risk appetite, how much return you want to make, right? We need to calculate that, and for what reasons, so we can find the optimal solution. Yeah. And then I can give you, I can say, hey, Ines, here is the maximum we can do. Mm-hmm. That's the possible return we can achieve, okay, giving your risk profile, time horizon, and whatever you want to do. Mm-hmm. So those are different systems. One is purely quantitative and works for short-term trades, mostly for revenue as a business. The other is a portfolio management system that uses the quant system as its base, yeah, for calculations to then apply for, okay, hundreds other portfolio management model. And that's what I license. Yeah. And then the quant model I run in-house, okay, myself. Yeah. So the quant model is kind of an input to the other, yeah, it becomes model, an input, okay, to the portfolio management model. That's completely correct. Yeah. And you mentioned, so depending on the goals, the horizon of the investor is going to be different. My question would be, how do you change or how do you personalize your portfolio based on those different goals and horizons? Yeah, that's so in terms of portfolio management models, you really need to look at portfolio management theory. And there are already set models there. Okay. The way you do it, I think for portfolio management, the most important, I guess, variable is risk appetite. If you can really drill down what's your customer, regardless if they're institutional or retail. Obviously, institutional it's very different because they obviously different mission there. But in terms of like a regular customer for, let's say, wealth management or portfolio management, once you get their risk appetite, how well they can deal with risk, how much they can lose in a certain time, or all that can give you really good insights of what securities they should hold. Mm-hmm. Because the goal is that once you look at your portfolio, supposedly, let's suppose you're my client, right? Or you use my software with another bank that is my client. The goal is that you feel comfortable that even if you lose 10,000 today, mm-hmm, right? You're like, okay, you know what? I'm comfortable with, yeah, that. It's within my risk, Yeah. The problem is when you lose, let's say, 50,000, and the maximum you should have lost, like it for your own risk level is 20,000, right? There's a huge disagreement there where there's way more riskiness. Okay, there's a lot of different ways of measuring risk, but a very common one is the standard deviation from any specific benchmark. But we'll say like, oh, you know what? This is what I can tolerate. Exactly. So we want to make sure that you're either in that space, what you can tolerate, or below. Always, the goal is to reach that specific point that you can tolerate, but it's really hard to find that because we work with cash questionnaires. It's really hard to translate them into actual numbers, right? And that goes with experience, the analyst, so you can't really fully program that. You can use AI to have to help you in that discernment. I think AI could be used as an automation tool for that specific aspect, but I don't think we're quite there yet. There's definitely need a human input to understand risk appetite, time horizons, and also to educate the clients. Most of the time, this is the one of the most important part to make the client aware that they might lose money. And they don't have to be scared when they see like minus 20% because the market's made like this. It's ups and downs. Not necessarily it's exactly that way. The whole point of I think that's the big distinction in terms of wealth management, private banking, portfolio management. The customer is everything. By law in Canada and CFA, CSC, you are instructed like almost as a requisite, like you can actually lose your license if you don't follow that. Is that the client has to be the ultimate goal is the client. Is the client's success is your goal before the company's success, right? And I think that's what's like that's why it matters when you really put all this together, right? You really want to make and the good thing about this industry is that when it comes to portfolio management, especially on a retail level, right, where you get customers that are not institutions, is that the client success becomes your success, right? So because you make a fee off their client success, right? So if you don't do a good job, you don't earn anything. So it's a good method to put the analyst in a position of always managing everything. Obviously, there needs to be safeguards. You don't want to take more risk than you should, and so on and so forth. But I think, it's definitely a great area. I think quantitative finance and portfolio management nowadays there's a huge gap between those two. The way most institutions work nowadays is that they use their quant team to create like models that are very general. Then they'll feed as input to those models, like I just mentioned. But the difference is that those asset managers, they're not really, there's other constraints for them, right? Because if you're a bank or institution, or if you work for a banking institution, at the end of the day, you have, I would say, could be a conflict of interest where you want to sell the bank's assets, right? So, think about this. Let's say you have, I think for a client, based on your risk, it would be good to invest on an index, on an ETF that tracks an index of S&P 500, right? If you're working for yourself or you're investing on your own, you're just going to choose a good liquid fund that can track the S&P 500 in a meaningful way and that you pay the lowest fees, right? Like it's pretty much kind of like finding a product in real life, right? You're trying to get the best thing for your buck. When it comes to institutions and when you work for a large bank, on top of all that, you also have to kind of like, I wouldn't say, I need to be very careful here. I think there's almost an incentive that is implicit that, oh, maybe you don't want to give BlackRock's ATF, right? Because you're a client of TD, maybe we should give you a TD one, right? The conflict of interest there arises because maybe the TD is not as good, which that's not the case. I'm just giving an example, okay? TD is a huge bank, so I'm sure they're doing well. Um, it's just that conflict of interest where an analyst or portfolio manager, junior portfolio manager, might get bonus for offering those TD ETFs, which I don't think is something problematic. I think it could possibly become something problematic.
We saw a situation where it clearly was the case a few decades ago when Goldman Sachs was selling the CDOs while buying CDS behind their clients' back.
Yeah, I
that
think
was a clear conflict of interest.
yeah, those are a good those are good scenarios because I think that shows what a conflict of interest can lead to.
Yeah. Because of that fee that the banks can gain out of that transaction. Like, I think it's a great thing that they implemented the law that you are doing everything for your client's interest. But there is other example that show that even with that law, this is not necessarily the best. For example, with Wells Fargo, they were saying that, oh, I'm doing everything for the client's like interest, but they were opening bank account and things without their client consent just to make the number grow. So
and that comes to the I think to the topic of like control and management, where the risk management for any financial institution, even if you're a one person job, risk management is everything. Uh, you know, you need to separate roles really well, and you need to make sure one, the culture, that's the number one thing in risk management. The culture is set in a way that people do want to obey the rules and do all that. And also, obviously, not putting people in those positions, right? You don't want to, for example, maybe TD has a fund that tracks the S&P 500 as well. Going back to that scenario, instead of giving a bonus to the portfolio manager to include that, right? Maybe they can offer some different type of compensation, and or really like create a software that can measure, okay, what's the big difference here? Ooh, me choosing the TD or this will cause a big difference. Probably not, right? Because it's still the S&P 500 index tracking.
Yeah.
So in that case, it will be good. But there will be specific cases where it won't be good. So it's good to the analyst to have like a way to control that and not fall into, I guess, bad decision making.
I think there is also a few concepts about quantitative investing that is hard to understand for most of the people. Could we maybe dive a little bit about what is market neutrality? If you can explain us with simple words what it is.
Yeah. So market neutrality is basically like on a quant-based model is you trying to benefit on both ends of the market, either if it's being sold out or if there's people buying, right? The way you do that is that it's very difficult, not it's very difficult to achieve this. And even if you do achieve some sort of model that can kind of do that, it won't work all the time. So it's almost like this utopia that any quantitative finance person wants, is that it's match the long positions returns that you want to have. Sorry, not long, but
Long term.
like buying, right? The buying with the betting against.
Okay.
Like you want both sides to make money in such a way that the sum of their risks or the average of their risks, that's not mathematically correct. I'm just making it easy, is zero.
Yeah, neutral.
So it's neutral, exactly. Meaning like the expected like variation and everything will be the minimum as possible by taking both positions of short and long in a certain stocks and sectors. Yeah.
You mentioned as well earlier about some mathematical models that you use, or statistical models that you use to build financial models. What are the mathematical models that you rely on the most? Is it, for example, regression analysis, machine learning? Like, what do you use most?
I think it's a good question. I think there's like different for each thing you want to do, you want to use a model, right? So for example, if you're doing a model, like usually historical models, we use regression
analysis
to see like for a very robust data set, if you have a lot of data, you can use more robust models than just a regression analysis. Uh, not that regression analysis is not good. It can be simplistic in a way where other models, they will, for example, they will enable you to almost like do a regression, but while you're walking through time. That's like what I guess a more professional model would be. Because a regression, if you just do a regular regression, will be at one point in time, and you want almost a regression that can go with time to see how you perform backwards, right? That's kind of like the first step. There are many models for that. They are really depends on your computing power at that point and obviously your technical understanding. But I think regression is definitely the start for most of these models. And for non-quantitative models, that becomes really complex. So that really depends on the person. Yeah.
Yeah, mentioning regression models, it based a lot about historical data. How do you make sure that your models are robust enough and not overfitted over historical data?
Yeah. So a regression model, if you're just using a regular regression one, would definitely be overfitted. That's for many different reasons. Because a regression, right, you have a static data set that you're like kind of like seeing, okay, what are the, you're getting a variable, right? That's like your expected variable, and you're kind of like trying to find out which variables matter the most in predicting this other variable, right? And I think it's a good mod, like a regression mod is really good because it's really easy for people to understand. You know, here's like X, Y, and Z, and here's how they can predict, W, right?
Yeah.
And I think that's really good. The problem with that in terms of financial analysis is that when you do it at specific points in time, and depending on the data set you have, you won't be robust enough to actually get to the core variables that matter, right? For example, if I run a regression of 10 years of data, it will show the aggregate within 10 years what variables matter the most, let's say. But the problem is this aggregate, right? You're almost amalgamating everything, so it loses almost the details of it. So what analysts will do, it's a very similar thing to a regression, but it's almost like they walk their regression over time, right? So you do in this day, this day, this day, this day, and then you create a system that is able to get snapshots of this regression in different period of time. So maybe weekly, bi-weekly, monthly, yearly, 5 years, 8 years, 10 years, 20 years. Then you can see, okay, how which variables matter the most, maybe in the short term, medium term, and long term. Because those would be very different variables. A strategy that may last a week will be completely different variables than a strategy that might last 10 years, for example. So that's literally so there's not any specific model. It really depends what you want to achieve.
You have to take out the data that's too far from like the data that can impact the models without giving like values. There is a lot of things specificity.
Exactly.
And maybe just to explain to our audience, because we're talking a lot about regression models, what it is for people that are not necessarily mathematical. A regression model, if and correct me if I'm wrong, is basically using historical data, like many points that you put on a graph. Let's say you have an X and Y graph and you have many data, and it's just point. And the goal of the regression model, it would be to create kind of a function or like a line or a curve that matches the most points with the minimizing the error in between the line that you're creating and the points so that the distance is minimal. And so, as we were saying, if there is some points or data that are too far from the line, it can impact not in a good way the models, just so you have a vague understanding of regression modeling.
Yeah, that's completely correct. So a regression model, see, that's the good thing and the worst thing about a regression model. It's an easy way to see what factors can contribute to, let's say, return on a stock. And like you said, right, you have different data points. Some of them will be extrapolated, will be outliers. And a regression model, if you have outliers, in data science or data analytics, a lot of people will try to remove those data. And in finance, yes, you can do that to kind of like make a more fitted model that can work for most cases, right? But those outliers, you don't really want to take them away, right?
Yeah.
The goal is here to, if you don't have the capability in terms of technical actual like computing power, or let's say you're not good at coding, so you're using Excel, a regression is your best case scenario. Okay, like that's actually really good. But when it comes to making something more robust, you don't want to take the outliers, right? Like you want to investigate why those
That's the
outliers
thing.
are an
Yeah.
outlier. So that's why you wouldn't, because a regular regression model is linear.
Yeah.
So that's your assumption that you're trying to fit the narrative that all these variables
Yeah.
in a linear fashion
Mhm.
will create this expectation of
Yeah.
W or Y. So, and that's not really what happens in financial markets, because you have different variables and returns. They don't look like a straight line, right? They'll look
Up
like
and
they
down.
can be curved up
Yeah.
and down, right? It's all like the heart beating system.
Yeah.
So you really want to make sure
If you're checking out a point, you have to make sure that it's an error. Like usually there is a whole analysis about a single point. Is it relevant to the model or not?
Yeah,
And
exactly.
you
Yeah.
evaluate how it impacts
Yeah.
the model. And if you think you can take it out and it has not a good impact, there is usually like some algorithm that you do on the can do on Stata on R.
Yeah.
I don't know if you ever used the launches on R.
Yes, I have.
So yeah, why am I asking that? Of course. So yeah, like there is different type of models to make sure that this point is relevant or not.
Yes, exactly. So yeah, you can use analytics model to kind of check on your work. Hey, is this regression actually fitting good over time? You know, in regressions, I'm not trying to discredit regressions. That's like actually the fundamental, like the base where you would start. So it is really good. Moving forward, though, you really want to encompass everything. So you want to work with models that are not restrictedly linear, right? Because so you can meet those curves and things to match the data, and you can really find out what are actually the data that matters in predicting a stock return at a given period of time.
Okay.
Yeah.
Yeah.
So yeah, I don't have any specific models to say, because it really depends on what you're trying to achieve, but that's where you kind of want to walk towards, is using more robust models that can take other shapes rather than just a linear line or.
And hearing about all that, it makes it looks very technical, very complicated. And most of the people, when they hear about quant models, they think about hedge funds or like high frequency trading. Do you think it's pretty similar and close to what you're doing?
Uh, it's similar in the fashion of data collecting and being very quantitative in decision making, but it's a very different approach. So when you talk about a hedge fund can work in any kind of area. You can have a equities hedge fund or a real estate hedge fund, even sometimes agriculture, like trading, like commodities. Uh, when you talk about equity hedge funds, the big ones will work in every single field. That's what tends to happen. And a lot of them will specialize in other things, and they will have something that they're strong on in terms of what they can do best. When we're talking about high frequency trade, okay, that's a very different than everything. High frequency traders use very technical analysis and a bunch of other models that needs to run very rapidly, very fast. So they need huge amounts of computing power that's extremely expensive. They need connection networks. They need infrastructure. They need a robust data center that is close enough to an exchange. They need to be connected to that exchange in different ways that won't impair their trades. And that's why it's called high frequency. You're really trying to trade on the minimum signals that you get from the market. That's a very different approach. is really useful because it does two things. One, it keeps the market efficient. It tells high frequency firms, trading firms, keep the market really efficient, right? Because they sell stocks and they buy stocks all the time, so it provides liquidity to the market. So they're really good companies for the market to work efficiently. Uh, but they're not your usual, I would say, investment firm. They're very specific. They're only numerical data focused trading, and they're very rapidly trading. They don't follow, a long-term philosophy or anything of the sort. So it's very different. And then what I do is quantitative research and trading. I I couldn't possibly compete with a high frequency trader, because there's much more infrastructure required for that, and data providers. So uh, it's very there's a that's possibly the highest barrier to entry to any market in capital markets. Possibly, it's high frequency trading.
There is a few other concepts that I think would be relevant to mention. I just think we might lack a little bit of time, so I'm gonna give you three of them, and you choose the one you want to go over it to feel the most interesting.
Yeah.
So we can be talking about tracking error. I think it's pretty interested, or we can be talking about margin guards or spread checks. Which one do you think is most relevant to talk about? And if we cannot talk about the two others, I invite you to make your research about it. If you have questions, let us know. But yeah.
Yeah. So when we're talking about, I guess a lot of those questions are focused more on the portfolio management side. Is that actually even the quantitative side, so the tracking the errors, that's that's with everything in data, but for a quant model, why is important is that, let's say you created a model that is able to tell you, hey, Ines, when you invest in this for this specific time, you should expect uh X% return. That's our expected return for a given portfolio. Okay. And we want the measurement, even if you're just trading, you're not really investing. Those measures are important for both solutions. Why? Because the how far away you're from that expected return, up or down, it's your tracking error, right? And that's really important because that's telling you, hey, you got 2% wrong, 1% wrong. It's great. But it could be 10% wrong.
Yeah.
And the idea here is that you want to find out why. Why did we have this error? You're never gonna get 100% right, because that would be fantastic. But that should be your goal, right?
Yeah.
You'll never get there, but
Yeah.
you
You have
want
to understand why you did
Yeah.
not get there.
Yeah, so you can try to get as close.
Yeah.
So the goal is to catch as close as possible to your expected return to be your actual return,
Okay.
right? And the way we do that is tracking those errors, like the tracking errors, like how far you are from the expected return and then we try to find out, okay, what happened? Then we try to maybe organize what happened. Can what happened be a crisis that your model couldn't possibly tell? Is that crisis out of your control? Is it a political, economic, a war broke out, right? Or it could be maybe actually model specific. Could it be that you didn't calculate this ratio properly, or could be that this ratio is not the best one to use for, so you start getting, and
You're
then
analyzing your own mistakes.
exactly, and then you separate them from something that you can action it, and something that you can't control, right? So the let's say a war broke out and nobody really expected, you can't really control that, so we're not going to focus on that. You don't want to model the potential probability of a war. Maybe you do, but I'm just that would be much more difficult. But you want to really focus on these things that you can control.
Okay. Okay. And moving on now, maybe I think we covered a lot about technicalities and some concept that you use in quantitative investing. And I don't want you bored too much with the details about that. So maybe let's go more into situation question. Like, what would you do if, let's say, for example, you have a stocks that's performing very well, regarding your model. It tells you everything good, but you don't feel like it. Like you don't feel like it's good. You think it's maybe overvaluated. Do you trust your gut, or what do you do in that situation?
Yeah. So I would say for whoever is trying to quantify things, I think a quantitative model, it's really like a reaction of that scenario, right? Like, uh, emotion is something that is not good. Like you can create a number for emotion really well or quantize it, I'll say. So you really want to trust that model, right? The model says, hey, you you should invest here. You really want to listen to your model because it took care of all those variables for you. I think an important thing here is the non-qualitative data, right? It's like, do you really trust it, right? Hey, the numbers could be good, but do you really trust the numbers? How do you know it's going to move forward with that, right? And I think that's an important question. And the way we do that is that you can either create a system, another model to verify how the talking points are going. Uh, Comes back to the whole AI of things. I can touch more about AI in the end, but the way people usually do is that they create a program to really like check the hey, is the earnings call mostly positive? Did they reach the estimates that they themselves put it? So their own guidance. Then we look at, okay, did they meet the guidance? Sure, yes. But did they meet the street guidance, right? Like what the street was expecting. So those are all variables that are non-quantitative and quantitative. They're kind of together. And I think it goes two ways for me specifically. I know other peers in the industry that really like tries to quantify everything. They use AI modeling for, analyzing all that. I think the human aspect of it cannot be not yet put into AI. I think you still need to check that part of the work. The one you said, hey, is it still good? Is it not good? I think you can have a system to guide you there, but ultimately you have to take that decision based on your knowledge of that company.
Okay. And have you ever had a moment where you model failed, like the market reacted very irrationally? And how do you handle this type of situation?
Yeah, so believe it or not, there are models for that too.
Oh, okay.
Yeah.
There is models for everything. Like, I feel like every
Yeah.
situation I give, you can create a model for that as well.
Yeah. So the whole, I guess we, it's funny because when you're an academic in finance, you learn that the market is very efficient. And that's true to an extent, but I would say it's mostly not efficient. And don't kill me for saying that. I think it's like the market participants, they all have their different goals, right? When we learn in school, we come to the assumption that everyone is going to be this rational player and they always do the optimal decision. But that's very like utopic. Like obviously everyone has different goals in life. So investment decisions are going to vary a lot. And like you said, right, there's a whole psychological thing. Like, you have one of the biggest weakness of the market is FOMO, right? And that affects
Fear of
anything.
missing out.
Yeah, the fear of missing out. Like that's what really creates a bubble. Gold starts going up, everyone wants to jump into gold.
Yeah.
AI starts going up, and then AI starts dropping, everyone wants to leave AI, right?
Yeah.
That's the type of sentiment and everything. And that's why we use the models. And you can quantify how people are, let's say, going mad in the market. The simplest way of doing that is to basically get maybe an index or a basket of stocks, and then you calculate the average like price per earnings ratio, the average change in stock price over time, and the change in standard deviation or variance of that stock over time, all those metrics. And you want to see what's the median or the average of those metrics are, and then you can set boundaries, right? Okay, if the average PE ratio of this firm, let's say for the past 10 years was 17, and now we have 54, right? Then it could be a good sign for you, right? To be like, oh, maybe this stock is super overvalued. Okay. That doesn't mean it is. It means it could be very well. So that's why you want to check it out. You want to create another model that can truly check. Now you got these outliers, right? These outliers can become your like, hey, this is what people are going crazy about. Maybe it's not correct. And then that's what you want to check later. And in an aggregate, like you put all that together later, you can truly see once you have that model laid out, you can be like, okay, yeah, people are going crazy. Maybe I should either divest from this market. Maybe there's opportunity to bet against this market. And that's what you do.
You mentioned a time where like markets were inefficient. I would say like it takes time to re-regulate the market, and one of the episode that showed us a pretty inefficient market was during GameStop, when the action went by a lot and was not reflecting the healthiness or the capability or cash flow or anything of the company, but it was just more a retail investors community hyped by internet and multiple things.
Yes.
And so how does models can predict this type of behavior that are unexpected from the market and that were unexpected by any hedge fund? And also, what does this type of event teach us about retail investor and the place they take in today's market? I remember off camera, I think it was when you mentioned that in 2004, retail investor reached 50% of the trades, which is huge.
Now 2024, it's almost 50-50 now. It's mostly like it's a lot of retails, and they're supposed to surpass actually institutional traders. So retail traders are investing more than institutions almost.
Yeah. And so how do you think those models can predict this type of behavior? Like what happened?
Yes.
And what can we learn from
Fair.
that?
Well, GameStop is a very specific case, I would say. So what happens with GameStop is that basically you usually with low value stocks, okay, either a penny stock or something that is a dollar stock, like so $0 to $10. Sorry, not zero, but anything above $0 to $10. What happens with those stocks is that anyone, even a retail trader, can buy in large quantities, right? Can apply a large volume. Okay. Usually those stocks, they're not stable because either they're very small companies, so you don't know if they're gonna do well or not. A lot of models for small companies, they don't work because the very definition of a small company is that it's very volatile, right? You have many workers at one point, less workers another point. You're really exploring where you enter the market and everything. So it's a very risky to invest in a small firm, like a very small or micro cap firm. And often or not, hedge funds use this to their advantage because the stocks usually have either a low daily volume, so they can easily change prices with very low volume application. And what happens then is that GameStop was one of those. And what traders were doing is that they found quantitative traders were like, you know what? We believe that GameStop is in a bad situation in terms of where they are right now. They're not performing well. Their fundamentals are weak. So we'll short the stock. Okay. So they start shorting the stock. And what happens is when you bet against the stock, you're basically selling that stock in a mechanical market manner. And so there's creates a lot of sell orders for that stock.
So that it goes
And then
up.
what happens is that the stock will tend lower, right? Like they'll start decreasing. And the more that happens, the systems, quantitative systems can track that change. The more shorts get open because those high frequency traders do that automatically. And that creates this squeeze, a short squeeze, right? And to the point where it becomes oversold. And then the other side of the market enters and tries to buy the stock because they believe it's too cheap. Usually, a single hedge fund can do both at the same time.
Okay.
Not in a market manipulation type of way. They can't manipulate that play, They can, but then it's illegal.
Yeah.
Like it would cause many problems. So they don't. But what they do is that they use those metrics to create that. And what happens is Wall Street Bets at the time, a Reddit forum, basically warn, like someone paid for short market data where they can see which stocks are being mostly shorted in terms of options or naked shorts, whatever it is. And they start posting on Reddit. And the idea is to get all those investors to then buy the stocks. And why would you do that? Is because when a hedge fund's applying so much shorting pressure on a stock that already has so much low volume, the price changes are really high because the way the price changes in the market for a stock, many people don't know that, is really directly dependent on the volume of trading of that stock during a specific day. So when you inject a lot of volume, either in a negative or positive way, it changes so abruptly that the gains can and the losses can be immeasurable. It can be hundreds of percentage points here. So we're talking. So when those retail traders invested against, it it caused many specific things for those hedge funds. Like they probably have to keep that play for longer, and that's not their job. So it causes inefficiencies with them. And if they want to keep it for longer, they have to pay the bank more. So it causes like huge amount of losses. And because they lasted so long, it pretty much dried those shorting desks from their capacity of staying in the play. So that means that, the more the stock went up, the more collateral they had to give it to the bank to keep the short position open. So they lost billions and billions of dollars, up to the point where even Robinhood, which is where the retail investors were mainly doing that play,
They took off the buy option.
yeah, they failed because the way Robinhood works is that Robinhood, whenever you invest in a stock, they will invest against the stock right away in a lot of times. And that's because they don't want to take the risk of holding or selling a stock. They just want the fee of selling that stock, right? As a brokerage. So they start a short position. So imagine when that happened, Robinhood was forced to start a lot of short positions against the buys, plus a lot of buy positions against the sellers and shorters. So it creates this huge spread that Robinhood at that time wasn't big enough to take on this. They didn't have enough money or market share, especially for that specific stock. So everything broke down. Basically. Yeah.
And so how are current models being able to predict this type of behavior, or like what is the main thing that we should take from that type of event?
Right now, the way, let's say if you're a short trader that, there's going to be a short squeeze in a stock and everything. Obviously now they check social media a lot. So there's a lot of, applications that are done programmatically, like coding, that scrape social media's messages. It connects to the social media API, or like Reddit has its own API, and then you're able to program something to go and check the comments, check what stocks they're talking about. So then that allows someone that is in that industry to really know if retail traders are coming to that play or not. So they can prepare for nowadays. It'll be really hard for that to happen again. They can really, they have the tools to prepare for it. Yeah.
And earlier on, we talked a little bit about AI, and you said that it helps a lot in the models to translate, I would say, the qualitative side of the data and everything. And so it's more and more implemented in models. I would like to have your take about AI in the quantitative models industry in the upcoming years. What place do you think it will take in 5 to 10 years in those models?
I think AI will be more and more significant, especially for the non-quantitative side. I think the non-quantitative side, the non-numerical side of quantitative trading or investing. The good thing about AI is that, say like you have a pure mathematical numerical model for quantitative investing trading that can tell you about ratios, can tell you how companies profitability level is, how they've been trending towards the years in terms of profitability, debt, everything, right? What they cannot tell you is how is that company's metrics, how healthy are they now, considering their space, their industry, and the geopolitics they started in, right? Like I can bet a quantitative numerical model will tell you Nvidia is probably the best stock to invest right now, but you will miss out on possible risks like the China and US trade deal risk, right? If something fails there, or possible taxation in the industry, semiconductor industry, or then even the fact that semiconductor industries are becoming more of a national security industry. What are the possible risks investing in that? Does that make it better of an investment or worse? You know, and that's something you'd have to create very specific programming for that it would work really well, but not optimally. And I think that's the biggest change is that AI can really come in and contextualize everything. So it adds that. So if you have like a macro and geopolitical model, you can tell the AI now to put those two sides of the model together. Like, okay, Nvidia is amazing, right, in metrics, but will the real world politics and economics uh, allow for Nvidia to for its full potential, right? And that's what AI can provide is that missing key that puts all together, and that's what you want. And I think that will be more and more demanded from AI from a financial perspective. I think AI will also be integrated into the actual even the mathematical models to change the weights. Let's say really like someone can make an AI decide is it a bullish, is it a bearish or a neutral economy right now in this country or in this context, and the AI will be able to really find out, hey, maybe we are in a bullish thing, so let's change everything to risk on type of trading. So I think AI will be a huge play in financial markets. It already is.
For sure. And I think it helps translate a part of, as you said, non-quantitative that was not easy to do before. And that's a great thing. For the last part of this interview, I want to dive in more about the advices you can give to students that want to pursue a career in quantitative investing. For example, if someone wants to just start to learn some skills about quantitative modeling, what advice would you give them? Like to start with Excel, with Python, or is there any other tool you would advise to start with?
Okay, yeah, that's a great question. Yeah, I think the key for modeling here, especially for a beginner, is Excel. For many reasons. One, Excel has inbuilt tools, so you don't need to create a lot of the tools like regression analysis, and all that's already inbuilt within the software. Also, Excel allows you to see the output, right? Like really see what's going on in all the ways, right? You have all the cells, all your variables. So I think it's really useful for beginners and even for more advanced traders or someone that is really want to get in advanced on that is that if you're are using programming, you really want to use in such a way that you're seeing what you're doing. It's not just lines of codes and matrix. You really wanna look at it. Yeah.
Okay. And so let's say if you could give an advice to yourself when you started modeling before you started your first model, what would that advice would be?
I think would be to focus one on data organization and like data cleaning more than I did when I first started. I think that's like fundamental. And data visualization. I think data visualization is very overlooked. People are fine just looking at a program and seeing in the program language, but that's not enough. I think data visualization is extremely important, especially for someone doing quant. There's so many things you need to take care of and variables. So if you can create a nice way to see all that together, that is user friendly, that's I think that's the ultimate goal. Yeah, because that way you're really seeing what you're doing and what's the impact of that. When you have just the data there, it's just numbers, right? You're not really uh visualizing how it matters.
Yeah. And finally, to conclude this interview, I'm wondering what keeps you motivated every day to refine your model. Is it curiosity? Is it discovery? Is it competition? Is it the money? What is it?
I think it's a mix of all of that, right? Like I think every day, like I told you, every day you have to work on these models. You have to find ideas and be creative about these models. And once you get set on it, you have to create this pipeline for it, all the boring stuff that comes before you can use this model. So I think like in a way is the ingenuity, like engineering of everything. You're creating something new. Obviously, what I think a great part of the whole journey is the reward. In this case, it's monetary because you're dealing with securities. But not just monetary. I think the fact that you can create a whole system that can obviously talk to you in a meaningful manner to give you advice on investing or trading. I think that in itself is a reward. But I think when well, how you check there if it's working, it's through returns. So I think the returns has a huge point there too, because that for a trader, for an investment manager, that's their report card. That's like, hey, did you do well in the test or not?
Yeah.
So I think all it's a combination of all those factors you explain. It's the ingenuity of creating something, having that something actually give you an output, and you get happy about it. And if the output is actually useful, you get even more happy about it. And if you can use that in a meaningful way that you can make money, then you want to find better ways to increase all of that.
Yeah.
Right. So I think that's how, yeah, it's a good rewarding system because it happens right away. I guess like
Yeah.
once you build it and you test it, either will work or not. And I think that's you constantly get rewarded, and because the market is so dynamic, and that's the unfortunate fact of this business is that maybe a model you did yesterday, it's completely
Yeah.
not useful today. But that's just the risk of things. That doesn't happen very often, but it can happen because obviously finance and systems and trading systems, all this changes every day, and that's just the risk you gotta take. But overall, I feel very confident, and I do feel very rewarded for everything I've been doing. Yeah. It's nice to see that passion, and I think like being able to quit your job and quitting your 9 to 5 to focus 100% on that is it shows passion. It shows a lot from your side, and being able to do that, I think it's very nice. And thank you, Joao, Thank you.
for
Thank you for
sharing
having me in your
all
show.
of these tips. I think and I think that show first of all that you don't need to quit your job to do that. Like he started when he was at university, and so you're able to do that step by step, and anyone can start
Yes.
giving information and like looking for information about how to build a model, and with time and with expertise, and the more you learn things and the more you talk with people and the more you learn to understand how financial markets work and everything, the more you're going to be able to use that input into your models and everything. So it was really nice discovering about quantitative investing and knowing that you don't have to commit fully to something to be able to start on that path. So
Yeah, of
that's
course.
that's a nice thing. Thank you for sharing
Thank you.
all
Thank
of
you so
that.
much. Yeah, it was a great time talking to you.
It
Yeah.
was so nice learning about all that, and I hope you guys enjoyed
Thank
quantitative
you.
investing as much as I did. And yeah, that's it. Thank you so much.
Thank you.